All right. Hi, everybody. Nice to be here and great to see everyone. Thanks for coming to the panel. My name is Nick Potter. I'm the chairman of the global insurance practice at the law firm Debevoise and Plimpton. I am at heart a mergers and acquisitions and corporate finance lawyer. I've been working in the insurance industry for about 30 plus years. And I'm very, very pleased today to be joined by a very illustrious panel, which I will do a very quick introduction. Binay Shankatia is on my left. Binay is a managing director at Portfolio Management at the Principal Financial Group's General Account Investment Team. He took over as the leader of that team after joining as co-leader in June of 21. In this role, Binay has direct oversight of the Principal's General Account investments, helping drive financial outcomes aligned with a robust risk-return framework and capital deployment strategies. It's great to have Binay here. To Binay's left is Andre Howie. Andre is currently the Chief Executive Officer, CEO, and board member for BB Seguridade, also chairman and a board member of Brasil Prev, Brasil Seg, and Brasil Cap. Andre previously acted as CEO and managing director of the Banco do Brasil Securities LLC in the U.S., served as a deputy manager at Banco do Brasil SA in Miami, here in Miami, and brings a really interesting perspective to this discussion from his operations down in Brazil. And lastly, on the far left is Robin Raju. Robin is the Chief Financial Officer for the Equitable Holdings. He's a member of the company's management committee. He's responsible for the treasury, investment management, general account and separate account general management, investor relations, corporate development, M&A, actuarial, accounting and controlling, corporate tax, financial planning and analysis, expense management, distribution finance areas. Without him, I don't know where the Equitable would be. So it's really great to have you here, and thank you all for taking the time to join us today. So our topic is indeed a fascinating one. The title is Navigating New Frontiers, the Impact of Private Equity and investment on growth in the life insurance and annuity sectors. This is a topic that's been consuming a tremendous amount of time, effort, and energy across the life insurance and annuity sector. So I'm very excited to get the perspectives of our panelists on this, as it is something that I think is completely, in some sense, completely reshaping some corners of the industry, some big corners of the industry. So with that, we're going to have sort of four general areas. The first one is going to be asking the panelists to talk about trends that we're seeing in the industry. Two, we'll be talking about the strategies of their companies as they think about addressing those trends. Three will be some sort of the tactical aspect of things. What opportunities are there for their companies? And lastly will be some discussion around the risks inherent in pursuing these opportunities. So we're going to start with a discussion of a general sense of the trends, so we have an understanding of what trends we're talking about. And with that, Binay, I might ask you to kick off with the following question. The increasing reliance on private assets in the construction of portfolio construction. Can you talk a little bit about those opportunities and risks and the trends that you're perceiving from your seat at the Principal?
Yeah, great. Thanks, Nick. Hello, everybody. Yeah, indeed, you talked about the key trends shaping the insurance industry. Clearly, the industry is getting more competitive. And in an environment where competition is picking up, you need to think about innovative ways to generate the returns that you need to compete and survive, right? And win, actually. So the big trend from our perspective in the way we are constructing our portfolios is increasing allocation towards private assets, whether they are private corporate debt. We've always been a pretty active investor into commercial mortgage debt, which is, again, a private asset class, infrastructural debt of private nature, private equity, and real estate private equity, Essentially, it's aligned with how our liabilities have shaped up since in the last 3 to 5 years with, shedding of some business lines to other insurance companies. And it allows us to get the best, mix between the capital we need to support our assets, between the risks that we take, and the returns that we generate. Having said that, the one, critical thing, Nick, is about, do you generate a portfolio, create a portfolio which is aligned with your liabilities, or do you follow the street or the herd? The answer is, of course, the former. You need to understand your liabilities very well, because if you don't do that, then you could be hit with having to liquidate assets which are very hard to liquidate. So therefore, our journey towards private assets is entirely driven by the composition of our liability portfolio And it gives us tremendous confidence to be able to extract the illiquidity premium that exists in private assets. Risk management is a critical element of this journey for us. I think of the risk team that supports my investment team to be critical for our success, and they have an equal say in determining the total outcomes that we are solving for, so that we don't get caught tomorrow in an adverse liquidity event.
That's great. Thank you. So what I'm hearing is yes, an increasing movement in the direction of illiquid private assets, perhaps greater yield associated with those assets, but definitely tempered by a sense of what are the liabilities that those assets are being held against, what kind of risk capital do we need to hold, and so on.
Absolutely. Asset liability management is a critical part of the process. You don't want to generate, for example, a lot of long duration private assets to support a liability portfolio which is short duration in tenor, because you may have to liquidate that if the liabilities are called, right? So that is critical for success. And if you can manage that process well, then there are premiums that can be exploited from illiquidity in the market.
Thank you. Andre, maybe you could explain a little bit. Your business is a little different from the principal or Equitable's business, which is maybe more asset heavy, U.S. life insurance and annuity and other types of products. But could you give the audience a little flavor for what your business looks like in Brazil and what trends you're seeing in terms of private equity and private credit gaining momentum, and how that's impacting your business and what opportunities you perceive?
For sure, Nick. Thank you very much. Thank you for the invitation. Good afternoon, folks. So let me get and explain a little bit about our business. I'm responsible for the holding company that's the insurance arm for Banco do Brasil. So we do bank insurance at all. We have a huge broker-dealer for one side, and on the other side we have investments on insurance, private pension, and capitalization and healthcare companies. Each one of these companies, they have their own policies for investments, for clients, also for their own prop funds, and also the holding. So regulation is very tight when it comes to the insurance market in Brazil. So in the prop funds, in the holding, we just do like treasury bonds and top-notch bank CDs, and that's where we go. But when we go down into each one of our companies, for sure, the insurance company, they can do private credit, they do private bonds as well. Private equity is not something they do much. Since we live in an environment of high interest rates, it's completely different from the U.S. I've been living in the U.S. for the last years, and moving back to Brazil, I can tell you guys that even the life and annuity sector is completely different. Here in the U.S., you guys have life as an investment. In Brazil's life is much more as insurance. So there's no investment component. We don't have universal life. We don't have term life. So when we look into private equity, going back to our holding, we do it as an investment for innovation. But when we go into our private pension company, they can do it, but it's very hard because our clients are looking for long-term. Interest rates are high. So public bonds, public multi-strategy funds where equity is the component, and private credit is booming as well. So there is a search for private credit. There's a lack of new issuances because everybody wants it. We're talking about base rate around 11-12%. So when we look into spreads over 2-3%, it's a lot, 15% per year. So it's hard, and everybody wants, and that's the environment we've been living so far. So we saw a huge spike on the growth of this kind of investments, 60% growth in this year so far. So when you look into new bonds or old issuances, secondary market, it's hard to find it. So living in an environment that you have nowhere to invest new money is pretty hard. So there's a fight between the players. Since we dominate in the more than 1/3 of this market when it comes to assets under management, imagine we must be very creative. So we have our asset that as a parent company that does our investments and where we go through. So we try to build partnerships with multi-managers so we can like diversify and find ways of getting the client's money invested. So that's the world I'm living in. Client's money, more diversified, proprietary money, more conservative, and that's it.
Perfect. And one question that came to mind also, in the Brazilian, call it retirement market, here we have the private retirement market with lots of MIGAs, different types of guaranteed, annuities with guaranteed returns on them. Is that product a popular product in Brazil, or is the retirement market there maybe more government driven, or how is it? Yeah.
So we have the social for sure, and there's the fiscal issue that comes along with the social pension plan scheme. But when it goes to private, you have like two very determined ways, like definite contribution and definite benefits. For sure, definite contributions are much more in the spot, but guaranteed return, that's not something that we work with. That's very hard to work along. So you have a minimum target that's per law and per regulation, have to attain it. But targeting above that, that's what we aim for.
Thank you. Great. Thanks. And Robin, over to you. The Equitable sits in a very, in some sense, a classic model of a sort of life insurance annuity company. You've got a tremendous position in the market. And in recent years, we've seen such an increase in the involvement of private equity, those companies and sponsors as they've invested in the insurance space, particularly in the companies that compete with you. What are your thoughts on this trend, and how do you expect to see it continue?
Sure. I think private equity is a good thing for the industry. And I'm going to articulate a little bit because this is what's brought about innovation in the U.S. retirement market. And the U.S. retirement market, for those of you who know, is the biggest market in the world, 137 trillion retirement gap that we see coming. There are 4 million retirees every year that turn 65. And it's a great opportunity for insurers to leverage their risk management skill set and leverage the capabilities and partner with distribution and asset management to solve that solution. Private equity, though, I'm going to link it to a little story about Equitable, and I think it links to the industry and where we are today. Pre-global financial crisis, the industry was focused on growth. And when I mean growth, it was really sales-driven at the end of the day in the U.S. retirement market. We had to talk about innovation. Yesterday, someone said innovation can kill you sometimes. Do you want to make sure? We had great innovation in products. We wrote variable annuities with options that you can't imagine. We wrote LTC, we wrote ULSG, it was great. A lot of people did well. We were part of AXA. AXA at that time was thinking about exploring this stuff to Europe. Luckily, the GFC hit before they put too much of this stuff in Europe and Asia across the board. But it was really a sales-driven gimmicks. The actuaries did a great job of creating great products, but it couldn't be risk managed at the end of the day. Then came the GFC. And all these, some people had to take TARP. Equitable, for instance, luckily we were a sub of AXA at that time. AXA had to inject its public $3 billion in Equitable to keep it afloat. And the mission in that next set of the journey for Equitable and much of the industry in the next 10 years with low interest rates and still trying to stay afloat was a fix-it mode at the end of the day. And it did bring about innovation. At Equitable, AXA said, fix it or get out of the U.S. retirement market. And what we did as a result, we wanted to be in through innovation and thinking about what client solutions we could offer, because we couldn't offer variable annuities anymore. We came up and innovated and developed the RILA market in the U.S. We started with 100 million of sales in 2011. It's now 60 billion of assets that we have in the balance sheet, and it's the fastest growing part of the retirement market. And I think it goes back to simplicity. We couldn't afford to write big guarantees on our balance sheet, so we focused on what can we solve. And we offered a buffered annuity with downside protection and upside potential, and it resonated with clients that were nearing retirement. And we've grown that across the board. Through that time, though, Equitable, like many other insurers, had to partner with private equity. We had to de-risk our legacy portfolio. Public shareholders weren't valuing it. We saw, I'm happy about the multiples these days, but I think in a McKinsey presentation that we saw, the life and retirement sector still has the lowest multiple in insurance, which is just amazing to me given the growth that we had. But we leveraged private equity for reinsurance. And private equity came in with their capital, which was great because no one else was giving insurance companies capital in the US. They came in the capital, they validated the model, and we were able to unload legacy blocks that had risk that they felt that they can better manage in the private setting. So that was a good thing for the industry across with private equity coming in. Now, as we see with larger higher interest rates, the demographic trends, most retirement businesses in the US have repositioned themselves to growth and captured an opportunity in annuities. Annuities over the last 15 years or so, they were stuck around 200 to 250 billion. In the last 2 years, the market's now grown to over 400 billion. Huge potential, aided by private equity companies, but also traditional companies like Equitable now growing again. We didn't talk about growth in the industry for a long time, and private equity helped infuse this growth mentality in the business for us. And now we're building on, as Binay talked about, investment capabilities that allows us to compete more and provide innovative solutions for retirement. Now, there is a but, though, in all this, and we're in a great place. We see tremendous growth across the board. But regulation always lags innovation in the US. And there are a lot of insurance companies that now have a lot of assets on their balance sheet from private equity companies where they may not fully understand the risk. And so we need to educate regulators and get regulators to catch up. There may be reinsurance transactions offshore to Bermuda or so on that may not have full transparency to local regulators. And so we want them to ask those questions, and we want to improve the dynamics of the retirement industry in the US. And I think with partnership with private equity, with private credit capabilities, there's such a huge potential for insurance and solving the retirement needs for the US that we can do it all together, but we just have to do it the right way. And we have to learn from the mistakes from the past and develop a healthier industry that has trust of both clients and shareholders. So I'm excited about the opportunity ahead of us. We just have to become disciplined as an industry and not, when we think about growth, talk about sustainable growth that can live for generations.
Yeah, it's extremely interesting to hear you put it that way. And the way, from what I hear when you say that is there's a world in which this is absolutely an optimal outcome for everyone. It's good for policyholders because the companies are stronger and continue to build the value necessary to pay all their claims. It's good for investors because it can return on equity can go up, the cost of capital can go down from companies that are performing well on the asset side of their balance sheet. And good for the regulatory environment if they can figure this out. As you say, regulation is always done in the rearview mirror. What happened last week is what's getting regulated next week. But if the regulators, I believe, are starting to be much more sophisticated as they think about what is private equity. It's not just this bête noire that's entered the industry, but rather something that has some characteristics that the regulators can understand and sort of properly evaluate. If you put all that together, it feels like some opportunity for all sides, hopefully.
Yeah, look, regulation plays an important role because all you need is one bad actor to hurt the rest of the industry. And who pays? The industry pays at the end of the day. And so it's important that I'm proud of what we do at Equitable, how we manage risk. I think some of the big private equity companies, they really understand their investment capabilities and investment risk. But there's a huge increase in smaller private equity companies. Everybody owns some type of arm of insurance in the US. And so regulators need to make sure that the rules protect the safety of the policyholders and ensure the sustainability of this.
And I just, so everyone's clear, that the comment about who pays, all the rest of the industry pays, that is a feature of the US insurance sector, that if a company becomes insolvent, there's a ex post gathering up of assets, assessing the other companies in the market to pay off policyholders of the insolvent company. So every company has a stake in what's happening with the PE sector. All right, well, this is great. Good discussion. In terms of sort of strategy, and so moving from trends to strategy for your own companies and how you're thinking about things. Andre, maybe I'll start with you. Could you talk a little bit about the strategy for your insurance businesses, where you see growth, where you see opportunity, and to the extent that private equity will play a role in that? And you touched on this a little bit in your first remarks, But just talk maybe a little bit about what your strategy is and what you're thinking as you look in this increasingly competitive market, where you're looking for growth and opportunities. Yeah.
Sure.
Yeah.
So going into the broad picture, like we're talking about a completely different market from the U.S. Insurance markets in Brazil like are about 4% of our GDP, and when we're talking with the private pension plans together, it's about 6% of GDP. In U.S. is about 10%. But when we look at GDP comparisons, like we're talking about like 2 trillion against 30 trillion, so we have much room to grow. When we look into the agribusiness, where we are leaders and we are have almost 60% of the market, not even like 8% of our total area that can be planted of total crops are insured. Here in the U.S., we have like a much larger. So we see lots of room yet, but where I see more room to grow is in the life and annuity sector. And why? We have a huge gap in our social security system, and we have to provide for that and to give access to our people, much lower class, so they can have savings in the future. So bringing the culture of investments, bringing the culture of savings for long term is what we're trying to do, not just as a company, but as a social and responsible part of the public sector. So I see room to, for sure, to increase our bottom line, but I see room as well to take part as a sustainable and long-term policy of like bringing the products to our people. When we go into, because like there's this difference, as I said before, into the U.S. and Brazil between private pension and life. But when we look at, if we embed it all together, we are talking about like an industry that encompasses like 1.3 trillion reais, what goes to like not even $250 billion, and where we have 30%. So imagine that we have like a huge space to grow yet, when we're talking an industry that for retail is about like $1.2 trillion. So like we have almost 800 billion to bring in to the investment industry on talking about life and pension. So that's where I see growth. When we look into private equity, in one of our companies, we have an insurtech, and we are trying to reshape it in order to invest in the private equity sector, but much more bringing the solutions into our ecosystem than making it just just only as an investment to make profit. For sure, we want to grow, we want the multiples, but what we want is to have the solutions that the market can bring to us and be part and controllers of it. So we are doing our business plans in this company, and we look into like a high-paced growth in the next 2-3 years by placing capital and investing. So that's what we're seeing right now.
Yeah, so sounds to me a more strategic and almost sort of activist approach to the private equity, trying to find partners and businesses that can help you build your products and services. Binay, how about you, from your seat as the CIO at the Principal? Maybe you could talk a little bit about your strategy, what you see as the structural attractiveness of private assets, and a little bit maybe about Principal's kind of journey in this area as well.
No, indeed. So the products we offer are primarily focused at 2 segments, right? One is the retirement market, whether, Robin talked about RILAs being a very attractive product today, the growth in the annuity segment. Our focus is a little different. We do RILAs as well. We just started them this year. Our focus is primarily to the retirement account. The 401ks where our guaranteed investment accounts are a big part of our value proposition to retirees. They can lock into very attractive yields for 3 years, 5 years. Beyond that, we are a fairly noticeable player, top 3, top 5 in the pension risk transfer market, where companies who offer the defined benefit plans to customers are kind of shedding them off because funding ratios have picked up. They do understand that the risks are better managed with the insurance platforms. Therefore, we are a big player there. That's been like the biggest driver of our growth as well. And then, serving the small and medium sized business segment through a full suite offering, whether it includes, retirement or getting to, group life, individual disability, specialty benefits, dental protection, and all that. So our ecosystem and our, growth targets are wired to this ecosystem. And but I would say that, growth in isolation for listed companies is not just a solution, because you need to be very mindful about the risks you're taking. Robin talked about how, people lashed onto the growth bandwagon back in 2007, 2008 without really understanding the risks of that growth that come with it. So our growth is very thoughtful, very, well-oriented towards our broader objectives towards not just, our customers, of course. Our customer is the starting point, but also our stockholders, because we are a listed entity, and therefore we have to be very cognizant about how much of capital we consume to pursue a growth and whether the return on this capital meets our shareholders' needs as well. Therefore, free cash flow is an important gradient of our policy prescription and our growth targets. But within the construct of that, my role as a CIO is to enable the businesses grow the business volumes they're targeting by creating a portfolio that meets their investment needs. And that is where, an allocation to private assets, which we've always made over time, brings us the desired results, but in a very thoughtful manner.
I want to build, maybe Robin, turn it over to you, but one of the questions, I think Vinay just raised, as well as Andre to some extent, is is there inherent, I guess the question is, what strategies are you looking at strategically to sustain long-term profitable growth as alts-backed insurers are entering the market? And one of the things I'd like to also focus on is this, what I guess you could argue is some degree of tension, i.e. you have shareholders, people who are providing capital to your business from outside, who want returns. They want to see a return on every dollar of equity that competes with, whoever you're competing with. Meanwhile, you have policyholders where, as you pointed out, the liability side of your business just requires a strong balance sheet that will pay out and ensure that policyholders the promises made to policyholders are clearly kept. You have regulators and rating agencies, all of whom have their own perspectives. And do you feel that as you try to manage a company like the Equitable through these different sort of competing interest groups, that is it difficult to find the balance, or is that a balance that sort of emerges as you pursue this strategy sort of organically?
No, I think that's a balance that's there, because at the end, for Equitable Holdings, we're a for-profit company. We're owned by public shareholders. And to be successful in the U.S. retirement market, you have to provide good solutions to clients. Like, we can try to make money all day, but if you're not providing good solutions for clients, addressing the needs of retirement, that leads to growth, which leads to for-profit at the end of the day. So our role is to make sure that we're upholding what we need to do with our principles, and keeping in mind all of our stakeholders at the end of the day. If you focus on just profit, though, it could lead you into wrong directions in trying not to leverage your edges that you have in the business as well. So Equitable today, we have an integrated business model. We own a retirement business. That's our leading franchise in providing individual annuities in the U.S. And also we provide advice to teachers in the K-12 403(b) market in the U.S. We do that through our distribution. So we own a wealth management business as a second leg of the model. And we're able to provide advice through 4,500 advisors that we have in the U.S. And then behind, we own asset management capabilities with AllianceBernstein. That integrated business model allows us to capture the full value chain in the U.S. That means that we can customize asset solutions, customize retirement solutions through our Equitable advisors and provide the advice. And at the end, through distribution, through manufacturing, and through asset management, we're getting returns that meet our shareholder requirements as well. So I think you can do both, and you should do both as good managers and good stewards of the business at the end of the day. Whenever you lose a track of who your client is and what you're supposed to provide them and the promises you make, especially in a long-dated business like the U.S. retirement and life market, you'll make mistakes at the end of the day. Now, where we see opportunities is to continue to build out on private credit capabilities in the U.S., and we do that through AllianceBernstein. We look at private credit in itself as a $1.7 trillion addressable market AllianceBernstein, we made a significant shift over the years. Those of you that are familiar, they used to be a large cap growth and value-oriented shop, very strong in that area. We made a significant shift in moving more towards private markets and building the private credit capabilities. It's now a $68 billion private credit market that we own in AllianceBernstein. That was all seeded through the retirement business in Equitable. So we have clear synergies within our business model as well, that we can build a higher multiple and a higher, more profitable business at AllianceBernstein, and we think that's going to grow to $100 billion. We've done that through strategies like CMLs, we've done European cred, we've done resi loans, we've done NAV lending. So we're building on these capabilities, but to be honest, we go into these strategies slow. We want to learn, we want to understand as we go into these strategies so we don't make mistakes in the insurance company balance sheet, which at the end of the day is we're looking to providing better risk-adjusted yields for our policyholders.
Do you, at the AllianceBernstein level, do you tend to try to build those strategies organically? We're going to figure out, we're going to go into CFO or CLOs, whatever it may be, or do you go out and look for opportunities to bring in sort of inorganically through M&A to acquire teams, to acquire groups that can bolster your capabilities?
We've done both. So it started with building the private credit capabilities at AllianceBernstein with the Equitable general account and seeding strategies. We have a unique business. We can go out and attract a team to say, come join AllianceBernstein. Equitable wants to invest in your strategies, and so they know they have money at hand that they can put to work day one. That is a differentiator for us when going out and recruit teams. As we've done that, our name got out in the market, and then you can go out and then you can operate in the M&A space. We've recently purchased CarVal Investors 2 years ago. That was about a $750 million upfront acquisition that we made that enhanced the capabilities at AllianceBernstein and gave them more access to more specialty finance, aviation, so more things that we can now work with to get higher grade structures that we can fit into general account. So we've done both, and I think to grow and build new capabilities, if you can do it as an extension. So for us, it was a low-cost investment up front. We're investing in yield. We're looking for risk-adjusted yield in the general account. We put the assets to work, gave it to the team. And as we've had a proven capability at AllianceBernstein, it allowed us to attract a team like CarVal, who had a big organization, good history of performance, and have them come over to AllianceBernstein.
Great. And I think that is a trend we're seeing quite a bit. From my perspective, you have two things going on. One is some of the large insurers, such as the Equitable, Pru, Met, Mass Mutual, list goes on, assuming, hey, we already have asset management functions that are quite sophisticated in the alternative spaces internally. So let's leverage those, build them out, go out, and we already have a name in the M&A market, and we can, part of our proposition is that we have the insurance company balance sheet that can be made available, so you don't have to go out and continuously fundraise to support your strategies. It's an interesting. On the other side, you have companies that are saying, hey, actually, let's not build this. Let's just go out and outsource some slice of our general account, and we'll go have a partnership with XYZ asset management, a private equity firm, and they'll do a separately managed account, and they'll take it, and we'll just kind of rent their capabilities. It seems like there are two strategies going on out there.
Well, I think some of it is a function of what you have as well. So if you go back to that point that I mentioned, post-global financial crisis, a lot of companies had to shed either their distribution or asset management because they needed to raise capital. I mean, ideally, if you're in the retail U.S. retirement market and you don't own distribution and you don't own asset management, you're leaving opportunities on the table. But if you don't, then it probably makes sense to partner in some areas, but making sure you understand the risk.
Great, thanks. Andre, back to you. I guess the question, so we've been talking about the involvement of private credit and investment in insurance. How do these things influence your company's approach to asset allocation? What adjustments are being made to align with these trends? When you think about the sort of assets on your balance sheet, strategically, as terms of the direction, are you thinking, okay, how are you thinking about that from your seat? Is it the same as the U.S. companies saying, oh, we're going to go build out an asset management, or are you thinking about it through a slightly different lens?
Sure. I was listening to my friend here, and it's pretty much the same, despite the fact that we do not do acquisitions, but we do partnerships. So first thing, like, are returns adequate? We have like multiple portfolios and multiple options for the clients to select, but the important part is that we have the benchmarks and we have to at least get into it. So by that, we have a very strong powerhouse, the biggest asset management in Latin America, but we are very strong on fixed income. And when it comes to alternatives or private credit, it starts to be a little bit difficult because growing organic, sometimes we are out of capacity. So we have to build partnerships. So yesterday I was having lunch with the CEO, Miguel from IIS Bernstein, and here's my friend from Principal. So we are partners in the company. So building these partnerships into our asset management where we can move into new strategies, where we can move into new asset classes is very important, and that's what we're doing. But not inside the company, but in our parent company. We have to push for that because the client, they need options and they are looking for returns. But as I said, great part of our clients' portfolios are allocated in funds that are allocated in fixed income. Private credit it's a great part of it, but the size of the market yet it's not as it should be. Equity is not where the client's money is. Like we haven't had a new issuance so far this year for new IPO. It's crazy, but since like with this high interest rates, it's very hard. So like growing partnerships, looking into strategic and thematic funds, looking into places where the demand is high, like for example infrastructure. So looking for places where incentives are high is the place where we are aiming to be.
It makes sense. I wanted to, so we have about a little over 10 minutes left. So, this so far we've been talking about the opportunities and some partnerships and the ability to go. So this is the dark part of the conversation, the risk side. And Binay, maybe I'll start with you. As we've been talking about this trend, we do see considerable opportunity. It is a heavily regulated industry everywhere you look. And yet, maybe you could talk about a little bit one of the issues that often is raised is liquidity. We've seen the banks have real liquidity problems. It was a year or so ago that we had, people thought the banking industry was really on the precipice. But could you talk a little bit about how you think from your seat again as a principal CIO about liquidity risks, and particularly as you've mentioned, if those investments are not well aligned with the liability profile?
Exactly. We are primarily in the job of credit risk and managing liquidity risk, right? I mean, in credit risk, we discussed about the move towards private assets. And one thing that's critical from our perspective is how close you are to the teams that are originating these private assets. Do they really understand the private assets? Because you could end up making the wrong decision about exiting some of those exactly at the worst point in time if you do not understand the risks, right? Historically, we've had like tremendous success in commercial real estate. We've got a multi-decadal successful platform there. But over the last 2 or 3 years, we built additional capacities, around direct lending, infrastructure, private debt, and of course, like real estate equity has been a big part of it. Moving on to the other side, liquidity risk, like we have a very, very, very significant ALM framework in the company where we assess the convexity risk associated with our both assets and liabilities. And the asset construction is intended entirely to support the liability profile that we have, with derivatives used as an interplay in bridging the gap between organic asset construction and the liabilities we have. So that is a risk that we always manage well. We try to manage well. We do not believe that taking duration mismatches is a core strength of Principal. We do not look at it as an alpha strategy for our portfolios. Therefore, our approach towards that is risk mitigation. And I think it's absolutely essential that portfolios that are more geared towards private assets are very well aware of the liability profiles. Otherwise, they could end up booking an extra spread, which vanishes because you might have to liquidate those assets exactly at the wrong time. And by the way, everything is great. The only time when you really need to liquidate is when things are not good. And when things are not good, forget private markets, even public markets go into disarray, liquidity vanishes from there. So you have to be very conscious about that element.
Right, and that makes complete sense. And again, a little bit at the crosshairs of the tension where you could say, well, look, but what we really need to do is go long on the duration, get the most yield we can. It's going to make our shareholders happy, right, and everything. And yet, potentially lurking within that is some liquidity risk that could, again, it's only a problem when it's a problem, in a sense.
Exactly. Yes.
Yeah. Okay, great. And Robin, maybe I could turn it to you as well. What do you see as risks and challenges? And we've actually had a couple of good questions come up on the screen that go to this as well. And maybe put on your hat as a consumerist. If you're a consumer of the products being offered by the Equitable, how do you think about this in terms of creating risk for the policyholder or creating risk for the company? And how do you see the mitigants to that, to any such risk?
Sure. Let me speak about private credit first, and then also consumer-based financing, which really is a big piece of it. That market's probably a $7 trillion market. It's going to grow to $10 trillion. And what's really behind that is U.S. middle market companies, small businesses. There are about 200,000 small businesses in the U.S. that fuel about a third of the U.S. GDP. To put that in perspective, that's larger than Germany and Japan. So it's a huge part of the U.S. market. They're fueled by private credit, consumer-based financing. So these are good investments. They fuel the economy across the board, and they're good overall. The question we have is how good are they for an insurance company balance sheet? At the end of the day, we should differentiate that when we spoke, because we're for those investments. But when you look at it from an insurance company lens, you really have to look through what are the risks within those structures. At Equitable, we pride ourselves, and we have an economic approach to managing risk. It's in our DNA. We inherited that from AXA, just looking at a Solvency II basis. And so we always look at the risk on an economic basis. You'll be surprised if I say, we really don't look at risk US GAAP or statutory. It's not the way to look at risk. You can get ahead of yourself and make some mistakes. You have to look at it on an economic basis. So if you take an example of CLOs, if you own a single B bond, that has a 9% charge under the US capital framework. If you strip that single B bond into a CLO, you own the AAA down to the equity, own the full tranche, that 9% goes down to 2%. That sounds fantastic, to stuff your balance sheet with that stuff at a 2% capital charge and probably get 200 to 300 basis points more yield than you would otherwise have. But is it sustainable at the end? Is it economic, those returns? You're owning the same underlying structure at the end of the day. And this has fueled a lot of the growth in some of the private structured assets within insurance companies' balance sheets. So I think those structures are good if you hold them above investment grade. But if you start going below investment grade, those tranches are very thin. And it doesn't take a big credit crisis to eat through shareholder capital and what you owe to the policyholder at the end of the day. So it's really important to look through and get comfortable with your internal investment teams, your risk teams, to really understand the risk and to make sure you're getting real risk-adjusted yields, not RBC capital yields at the end of the day. And there's a balance between that across the board. So I think it's on us. Again, I go back. We're trying to generate sustainable growth. We have such a great opportunity in the U.S. retirement market. If we want to stuff balance sheets with high yield, low capital oriented assets, at the end of the day, these things haven't been tested through a credit cycle. And we can go back to and make the mistakes on the asset side that we did on the liability side pre-global financial crisis. So it's on us as the industry, on us as teams to ensure that our teams are supporting these assets, because again, they're good assets for the U.S. economy, but recognizing when you put them on the insurance company balance sheet that you are taking risk and understanding those risks and making sure you're smart about where you leverage those asset classes.
That's very well put. And I think one of the questions on the screen is, will regulators take action to address what's become maybe an unlevel playing field between traditional life and PE-controlled insurers? And I just want to comment on that for a second, because the answer is yes. And the regulatory community in the U.S. is all over this issue. It's on the agenda of every NAIC meeting. It has been for a long time. Specifically, for instance, to address the point that Robin was just making, there's a whole new initiative within the NAIC to come up with a principles-based definition of what's a bond and what's a credit relationship, and intending to make sure that this, there's no sort of credit arbitrage or capital arbitrage for the assets that are being originated in this private markets and being put on insurance companies' balance sheets. That's a very specific example. It's been it's a heavily regulated area. And from our perspective, we see a lot of focus also on the control people and any kind of conflicts of interest between the PE firm and the insurance company that it controls. So I do think regulators are quite focused on this topic. They absolutely are. And what one hopes is that you don't have this sort of outliers who are flying a little bit underneath the regulatory radar who could create problems in the industry.
I mean,
Yeah.
you make a great point. I mean, the last thing, providers need is weak regulation.
Yeah.
Because you get a failure and then the whole cycle goes backwards multiple years, right?
Yeah.
You become too defensive. You become like, you start avoiding risk versus taking the right risk and managing appropriately. So it's our job as,
Yep.
providers in the industry to educate our regulators to the true risks and then, get to the required capital, the regulatory capital, so that the gap between, as Robin pointed out, the economic capital and the regulatory capital starts getting narrower.
Perfect. We have just a couple of minutes left, so maybe I'll turn it to the panel. And Andre, starting with you, sort of any final thoughts or observations about this topic, things that as you sort of daydream a little bit about what the investment landscape is going to look like, things that it might you think the audience should take away.
We should take the lesson of what happens here in the U.S. For sure, like last year's, if interest rates have been spiking here, it's like it's much like what's happening in Brazil. But when we look into the different asset classes, the different fields, and where we can move forward into products, much in the life insurance spectrum, we should learn and try to absorb what goes on here. We have a much more options for clients in the U.S. than we have in Latin America, and that's my quest. I always request my partners here in principal in our private pension business, like let's bring more technology into our product. So that's my take for it. Like we have to learn, we have to develop. We're still in a very early brownfield market. The last years for Brazilian and Latin American markets were very important for long-term savings. There are a couple of companies that changed the mindset for our people, but still we're very far from that. And if we do not save, the future of our population will be compromised. So I do believe that bringing the edge of technology and products, bringing innovation and bringing what I have learned here into our ecosystem will help develop our markets and bring more and more clients and socially help our people in our economy. And I hope we have talked about a little bit about AI because we haven't asked about that before. So thank you very much. That's my take.
And I know we're almost out of time, but Robin, any final thoughts from?
Look, I think we need to embrace this private capital that's coming into industry. It validates what we all do every day, that it's a good thing, that we offer good things to clients, that they see the demand there across the board. But we need to go in eyes wide open, understand the risk, and again, go for sustainable growth. And that's what we're excited for in the U.S. retirement market.
That's great. And Binay, bring it home. Any final thoughts?
It's a great confluence, in terms of private capital flowing into supporting liabilities, and then, on the asset side of, we buying more of private assets, again, in a very risk-conscious manner. And I think these are exciting times for U.S. insurance industry. And like I said, it's all on us to ensure that we kind of, continue to offer what the customer needs, because ultimately we all are here because of the customer, and customer centricity has to be at the core of what we bring to the table.
Great. Perfect. Well, that's great. Well, I thank our panelists very much. It was a terrific discussion. And, excellent.